Hello everyone, thanks for checking out my video. The US stock market ended a turbulent August on a high note as positive inflation data set the stage for a long-awaited rate cut. S&P 500 clinched its fourth consecutive winning month, while the Dow Jones hit a fresh all-time high. This came after we saw a massive sell-off in early August. And just when you thought August was wow and crazy enough, I believe there's more to come in September, as September has been known as the worst month for the stock market. With more economic data and Fed's meeting coming up, the volatility could be worse than August. In this video, I will be sharing some of my plans for September, so do watch till the end of the video to not miss a thing, alright? Okay, let's do a quick recap. The US stock market overcame a volatile August after the major indexes experienced a steep sell-off at the start of the month, with the S&P 500 losing as much as 7.3% before recovering by the end of the month. In fact, on the very last trading day of August, we saw a late spike in the market, pushing all three major indexes to a winning month. Last Friday's gains were likely due to the latest positive reading of the Federal Reserve Preferred Inflation Gauge, also known as PCE Index. The index rose by 0.2% and 2.6% on the monthly and yearly basis, respectively, in line with market expectations. The market saw the cooling inflation report as a data that solidifies the Federal Reserve's expected interest rate cut at its upcoming September's FOMC meeting. In case you're not aware, Fed Chairman Jerome Powell recently made it quite clear that the central bank is positioned to begin its rate-cutting cycle. To quote him, he said, "The time has come for policy to adjust." Looking ahead for this coming week, investors will be eagerly anticipating the August jobs report, which is set to be released on Friday, 6 September. Like the Federal Reserve, the market's focus seems to be shifting from inflation data to the labor market. It appears to me that the recent jobs reports have become a market-moving data, just like the CPI. Basically, it's getting more attention than normal. Just to add, the upcoming jobs report is the last big data from the labor market before the next Fed's FOMC meeting on 17 and 18 September, where a rate cut is widely expected. By the way, to refresh our memory, last month's jobs report was a big miss, which resulted to a widespread recession fear and that the Fed was too late in cutting rates. So for the upcoming jobs data, if it's a bad print, the stock market could react badly again. But of course, on the other hand, a better than expected figure could potentially push the market even higher and probably to a new all-time high. Meanwhile, the speculation of a 50 basis point cut versus the current expectation of a 25 basis point cut will definitely continue till the FOMC meeting. Okay, jobs report aside, two other things to note for the week. First of all, the market will be closed on Monday for Labor Day, so do take some time off the market to spend time with your loved ones. Then on Tuesday, when the market reopens for the new month, we will have the final reading of August manufacturing data, which will likely come in below the 50 mark, which indicates a contraction. Alright, looking beyond this coming week, if you don't already know, the month of September has been a seasonally weak month for the stock market. This means that the latest recovery and rally in the market will be put to test. But whether we will end higher or lower by the end of September, it's difficult to predict. But in my view, there is a high certainty for a more volatile month than August. Let's now hop over to the technical analysis section. Well, the market held up pretty well last week despite a sell-off in the hottest stock of the year, Nvidia. SPY is currently in a period of consolidation, trading sideways near the all-time high. Okay, we can't know for sure how long this consolidation will last, but we can look out for key resistance and support levels to seek confirmation that SPY is breaking out. In terms of the upside, very simple, watch that current all-time high at 565. As I have always shared, if an index or a stock hit a new record high, most of the time sellers will dry up because investors will hold on to their winners at least for a while longer before they start taking profits. I know it's quite difficult to see on the chart, but the next Fibonacci resistance level above the current record high of 565 is around 578. I don't know if SPY will hit that level or not, but closing above 565 it does give us some chance to see at least 570. On the other hand, if the bearish seasonal September thesis plays out, I would think minimally, SPY will head towards the big gap between 544 and 548. Coincidentally, the top end of the gap is where the 50 moving average sits, while the bottom end of the gap is where the critical 61.8 Fibonacci level is. This translates to a strong support zone. So if SPY doesn't bounce from here, then we can expect to see SPY at 530's level again. Personally, I will be watching the gap and the support level of 538 closely for the month of September if there is a pullback. This could be potential areas to pick up some shares. Not financial advice, of course. Okay, moving over to Apple. Apple is still on this nice little uptrend, but it seems like it's stalling out as shown by the candlesticks from mid-August onwards. It could be the best losing strength, or could be Apple taking a short break before going higher. So how do we know which scenario it belongs to? Okay, for the upcoming weeks or perhaps even for the month of September, watch the level 221 closely. This is a double support level formed by the crucial 61.8 Fibonacci level and the 50 moving average. If this 221 level breaks and if MACD has a bearish cross, then Apple has turned bearish, and that's when I think it could go below 216. But even if this happens, it wouldn't excite me yet. I will only be slightly excited if Apple drops to 205 level. This level is important because, as mentioned in my last video, when 205 breaks, Apple has a high probability of falling to 195, something that happened twice recently. If we ever see Apple at 195 in September, then I will be more excited. Okay, in terms of the upside, just like SPY, quite straightforward. Apple has to go above the recent all-time high of 237. When that happens, then it's uncharted territory for Apple, and naturally, 240's range will be in sight. But be very careful, if Apple goes near or briefly touch the all-time high and gets rejected, then we could potentially have a bearish double top pattern forming. And oh, in case you're not aware, Apple has an upcoming event on 9 September where they will be revealing the new iPhone 16 and other major devices such as the Apple Watch, AirPods, etc. This event will likely set the tone for Apple's movement in the month of September. Alright, let's now move over to Tesla. I have tidied up the chart a little bit so that it's less cluttered and also to reflect the latest movement. Okay, Tesla looks really interesting at the moment. If you can see on the chart, the MACD had a bearish cross last Thursday, but then that only lasted for a day as Friday's rally reversed the bearish MACD cross. So that's a bit bullish, right? At the same time, since 20th of August, Tesla has experienced a bit of difficulty breaking above that new blue downtrend line that I have just drawn, so that's a little bearish. And then we had a rejection at a 50% Fibonacci level, that's bearish, but a nice bounce off that 23.6 Fibonacci level, that's a little bullish. Wow, okay, that's a lot of conflicting signals. This just shows how volatile Tesla is and how the very short-term trend can change very quickly. This is also why I have been day trading, swing trading and wheeling Tesla for almost the entire month of August. As you can see, the last 15 trades were all on Tesla. Okay, sorry, I digress. So how do we dissect the chart then? In terms of the upside, the first step is to break above that blue downtrend line. By doing so, it's not enough. We need to see Tesla not getting rejected by the 50% Fibonacci level at around 227. Even if we can close above 227, that's only slightly bullish. For me to call Tesla bullish, it needs to fill that big gap between 234 to 245. By doing so, it also means Tesla would have gone above the critical 61.8 Fibonacci level at 237. The longer Tesla stays above 237, the higher probability that it will hit back to 250s and 260s range. But on the other hand, if Tesla continues to get rejected by the blue trend line and worse still starts falling below that 23.6 Fibonacci level, then I think Tesla could revisit 180s range. To also highlight that 23.6 Fibonacci level, which sits at 203, is also where the current 200 moving average is. Therefore, they formed what we call a double support level. Tesla did bounce off this level last week, but if it retests this week and fails to bounce, then the bearish thesis could play out. Alright, we will now check out Google's chart. Google looks a little bearish to me despite that rally on Friday for a couple of reasons. First and foremost, can you see the 3 red candlesticks that I have boxed out? That's called 3 black crows, which indicates that bears overtook the bulls during 3 consecutive trading sessions. That's obviously bearish. But of course, we cannot rely solely on one indicator for technical analysis. So another bearish sign is that the stock price got rejected at the 38.2 Fibonacci retracement level, which sits at 169. On top of that, it has also closed below the 23.6 Fibonacci level for 3 consecutive days. Alright, will the bearish trend continue, or will last Friday's rally stage a comeback for Google? Okay, for confirmation of the bearish trend, watch that MACD closely. It almost had a bearish cross last Friday until the late spike in the overall market. Can you see this intraday chart? Check out the huge green candlestick. Anyway, for this week, if MACD starts to curl down, we do then have a high probability to see Google hitting 150's range again. At 150's range, pay very special attention to where the recent low and 200 moving average are, specifically at 155. Anyway, I shared it last week that this 200 moving average is important for the bulls to protect. The last time when this moving average was tested, it was in March 2024 and Google rebounded strongly. And again, like what I have shared, this could be an area for me to pick up some shares or to sell put options or both. But please, this is not a financial advice. And a word of caution for you is that if this strong support level breaks, it could decline a lot more. Okay, the market is always unpredictable, so who knows, Google may not test the 200 moving average or the MACD may do a U-turn. If that happens, we would want to see Google reclaim both the 23.6 and 38.2 Fibonacci levels at 164 and 169 respectively. It will be even better if Google can create new higher lows in the process. When these 3 things happen, I am of the view that the bullish momentum will likely bring Google further up to the 50 moving average level at 173. Moving over to Meta, sorry I'm gonna be like a broken recorder and repeat this inverse head and shoulder pattern again. So last week Meta did show some signs of weakness as it retraced from the all-time high, and MACD had a bearish cross. But I wouldn't go short on Meta at the moment. For Meta to be caught bearish, it needs to fall below 505. There's a stubborn support level formed by the critical 61.8 Fibonacci level and the 50 moving average. When that happens, there is then a very high probability that Meta will continue to grind lower below 500 level. The next support level below 500 is 492. Once again, this is also a double support level formed by the 100 moving average and the 50% Fibonacci level. If this level also breaks, I would say Meta is very bearish because another bearish pattern will be playing out, which is a double top pattern. But on the other hand, if last week's retracement was just a small break for the bulls, then we would like to see Meta retest the all-time high again at 544. Just like what I have mentioned earlier, at all-time high, don't go about shorting it. Just let the winner run and see where it brings us to. Alright, all in all for Meta, pay very special attention to the level 505 for this few weeks. Let's now jump over to Microsoft's chart. Microsoft isn't looking that great as well. Let me explain. First, we got a rejection at the 50% Fibonacci level. Forgot to mention earlier, other than the 38.2 Fibonacci retracement level, this is another common Fibonacci retracement level where rejection often happens if the main trend is still intact. Right now, the obvious short-term main trend for Microsoft is down. Secondly, to make things worse, Microsoft also got rejected by the 38.2 Fibonacci level, so that's double rejection. This shows that the bulls are lacking strength to bring the stock price up. Thirdly, just like a few other Mag 7 tech stocks, the MACD is also on the verge of having a bearish cross, but it's not confirmed yet as it was also saved by last Friday's late market surge, so you might want to pay attention to this MACD this week. If and once MACD crosses down, we can expect the 200 moving average and probably the 23.6 Fibonacci level to be tested, and around 404. From here, if Microsoft bounces, great. If not, similar to what I have shared last week, the last line of defense lies at 385. This is one big support level. If this support level breaks, there is a very high chance we will go towards this mini consolidation zone in the 370s and 360s range. Okay, one more thing. Something that I have highlighted last week and worth recapping is that Microsoft so far has reacted quite well when it tested the 200 moving average. It went below it for a while on 2 occasions, but bounced back up strongly. And last week, Microsoft briefly tested it for only just 1 day, and it bounced up immediately. Therefore, come this week or maybe even next week, I will be watching this moving average very closely because I am waiting for opportunity to sell a put option on Microsoft. In terms of the bullish thesis, it's quite simple. If Microsoft can continue to bounce and stay above the 200 moving average, then it's not all that too bearish yet. But for the short-term bearish trend to reverse, at the very least, we need to go above the 50% Fibonacci level at 326. For me to call Microsoft bullish, it's quite an uphill task. Microsoft needs to reclaim the 50 moving average and also go above the critical 61.8 Fibonacci level. These levels are at 430 and 436 respectively. Okay, last but definitely not the least, let's have a look at Nvidia's chart. Well, Nvidia reported decent earnings last week, but Wall Street has sky-high expectations for the company and wanted more than what they saw. That was probably why there was a sell-off post-earnings on Thursday, though Nvidia did recover a little bit on Friday. Okay, the chart looks bearish at the moment, obviously. The stock price has gone below the 61.8 Fibonacci level of 122, gone below the 50 moving average of 120, and the MACD is dangerously on the verge of having a bearish cross. If the MACD crosses down this coming week, and if Nvidia breaks another Fibonacci support level at 115, I think we could go below 110 or probably even go near 100 level again. Pay very special attention to 100 to 102 level. If this area breaks, there's not much support below actually, which means we could see Nvidia falling further towards 95 or even 90. On the other hand, okay, a quick 120 seconds. If you like my content so far, do help to support this channel by simply liking this video and comment something below. And if it's within your financial means, you may also consider buying me a YouTube Super Thanks or a cup of coffee via my Ko-Fi link. Alright, back to the chart. For Nvidia to resume its uptrend, 2 key levels to watch, and they are 122 and that blue downtrend line. By going above 122, it means Nvidia would have gone above the 50 moving average as well. That's the first step towards regaining the bullish momentum. But the blue trend line seems to be a strong resistance to break, which also means a break above it, Nvidia will be free, per se. That's when we could see Nvidia going above 135. Wouldn't surprise me if Nvidia starts testing the all-time high again at 140. But yeah, the prerequisite is it has to go above that blue downtrend line decisively. We are talking about 2 to 3 green solid candles. Alright, moving over to the options trading section. Last Friday, I had 3 contracts that expired. Let's break them down. First up, it's this cash secured put on Nvidia that was sold on 17 July with a strike price of $95 and 30th August as the expiration date. So what happened on 17 July was that US President Joe Biden reportedly plans to impose more trade restrictions on sales to China. As a result, major chip stocks fell. Specifically, Nvidia dropped 6.6% on that day. Can you see the huge gap down? That was an overreaction by the market, at least in my opinion. And if you have been following my channel, you would have known that I love stepping in to trade when the market overreacts. And that was why I sold a put option, which is a slightly bullish move. Well, Nvidia actually continued to fall for the next 2 to 3 weeks, but it managed to bounce back up quite nicely after hitting 90. And then on expiration date, which was last Friday, Nvidia closed above my strike price of $95. As such, my contract expired worthless and I got to keep the full premium of $193 without having to close my position. The second trade to update is also a cash secured put on Nvidia, sold on 24th July, 1 week after the earlier contract. Anyway, this contract has a strike price of $90 with the same expiration date, 30th August. The rationale behind this trade was very similar to the earlier trade. Basically just two things, gap down and a more than 6% drop. But to make this even better than the earlier one, this sharp decline came with no news. No negative news on Nvidia or the chips industry at all. Once again, it was a little overreaction there and the sell-off was uncalled for. That was why I stepped in again to sell another put option, even though my first Nvidia trade was in the red. So, as mentioned earlier, Nvidia continued to fall but managed to find support at $90 and bounce back up. Similar to the first Nvidia put, this contract expired worthless last Friday and I got to keep the full premium of $140 without having to close the position. Just to add on, both contracts were sitting on a huge paper loss at one point. Look at how they have swung more than 300% to give me full profits. And that's the beauty of selling options with expiration dates that are about 1 month or 1.5 months out. It gives the stock some time to recover. To add on, time decay is on your side. If you are new to options trading, do check out the video linked at the top or my options playlist. They are all beginner friendly. Okay, the third trade to update is this cash secured put on Google, which was sold on 18 July with a strike price of $160, expiring last Friday, 30th August. Okay, for this trade, I got to be honest, when I sold that put contract, Google was at sub 180s range, and I saw that Google has been declining quite a fair bit already, and I also saw a number of key support levels in the 170s range. At that point, I was of the view that Google will likely bounce up. But I was wrong, I have to admit that. Google gapped down on 24th July even when it reported decent earnings. For a while, my strike price was breached as Google continued to fall towards the 150s range. And from 191 to 155, that was a close to 19% drop. Who would have expected this for Google? I definitely did not see this coming. So once again, going back to the beauty of selling options, there is this phrase that I shared in my options videos. You don't have to be 100% right, you only have to be approximately right. And I think this trade is one good example. As you can see, I was wrong about Google finding support in the 170s range, but I was kind of approximately right that Google will likely float above my 160 strike price on expiration date, which it did. As a result, my contract expired worthless last Friday, and once again, I got to keep the full premium of $185 without having to close this position. Well, the total profit from the 3 trades is about slightly over $500 after deducting the transaction fees. Okay, if you have watched till this section, thank you very much. Let me share with you some of my plans for September. But before that, let's talk about September versus the stock market. According to LPL Financial, since 1950, the S&P 500 has generated an average loss of about 0.7% in September and finished higher only 43% of the time, making it the worst month for stocks on an average return and positivity rate basis. To add on, the last 4 Septembers have also been rather weak, with the S&P 500 posting respective declines of about 4.9%, 9.3%, 4.8% and 3.9%. Also, during the month, the index tends to trade sideways during the first half, with losses beginning to accumulate into the month end. Alright, so what should we do? Should we sell our stocks and buy them back in October? Okay, I can't speak for you, but I will share with you my plan. First of all, I know I have repeated the same message over the past few months that I am generally bullish about the market till the year end, and so far that has played out quite well, fortunately. But right now, I would like to share that I will be adopting a cautious approach as we enter a potentially bearish September. Okay, that's for the mindset component. In terms of action, I will be eagerly anticipating for a potential pullback and be ready to deploy my cash on the sidelines. Another potential action that I could take would be to sell put options in September with expiration dates in October. So if the bearish seasonality trend plays out, I could be able to reap some profits in October. If I don't recall wrongly, this was what I shared and what I did last year. You can check out that video if you want. Alright, with all that being said, that's just my personal plan and they are not financial advice for viewers out there. And to complete my sharing, I thought it's better to highlight the potential downsides to this plan. Firstly, statistics are just statistics. They are not 100% accurate, which means this September could be different, and who knows, we could see a very green September. And when this happens, it means I wouldn't be able to deploy my cash, nor am I able to sell put options with decent premiums. Secondly, with so many key events happening and coming up such as rate cut, jobs data, CPI, ongoing wars and geopolitical tensions, US election, etc., volatility can be really high, and that could make it difficult for someone or for me to decide when to enter the market or when to sell put options. Thirdly, what if September's bearish trend continues into October or November? Then my sell put options could be assigned or have to be rolled, and that can be stressful for some people as you will have to manage and monitor your options positions closely. To sum up this video, I would like to say that September may potentially bring some seasonal challenges and volatility, but if investors can navigate through them, these headwinds can turn into advantages by the end of the year. Okay, that's my plan for September. What about yours? Would love to hear them in the comments section below. And as usual, don't forget to like this video before you exit. Thank you.